Hi everyone, it's Chad back with another video. Today I'm going to be talking about Aston Martin Lagonda, the business behind Aston Martin Luxury Cars and the Aston Martin F1 team. Currently trades for around £1.5 billion, way off its 52-week high of around £3.50, but again, way off its 52-week low where you could have picked it up for under £1. This is not a consistently profitable business, although it is in the midst of a big turnaround and it does not pay a dividend yield. I want to establish whether this company has a clear path back to, well, not even the IPO price. The IPO only a couple of years ago was around £25, which just seems like a million years ago right now. It's currently trading around £2.20. Can it get back to around that £10 mark? Remains to be seen. I'm going to talk about what I think of the business so far, whether it can get back to reasonable levels compared to its IPO, what I think about its prospects going forward, and how I think it's valued right now. This business really struggled in 2020 and 2021, so it's nice to see that in 2022 they had a relatively strong year, albeit coming off some lower bases. Revenue up 26% year over year across strong demand across the portfolio. Wholesale volumes up 22% year over year in Q4, driven by the DBX 770 deliveries. A lot of new product launches that have been relatively successful. They've branched out over the last 2 years into producing SUVs. That's been very successful. They've added new goals to reduce their annual carbon reduction from the manufacturing facilities. They've got into F1 or continue to increase their partnership in X1. And they believe that 60% of their customers are new to the brand, and this has been amplified by the F1 partnership, which is really nice to see. Overall for the full year, total wholesale units up about 5% and revenue up, total revenue up around 30%. This is excellent. Adjusted EBITDA was also up nicely to £190 million from £138 million the year prior. However, these are all adjusted metrics and this is not a consistently profitable company. Free cash flow loss expanded dramatically to a loss of £299 million compared to £123 million the year prior. Adjusted operating loss also increased £118 million from £74 million the year prior. And while they did get that net debt down, which is very important obviously, from £892 million to £766, that's still around 50% of the market cap, which is a little worrying. And overall, it's just not a consistently profitable company, and even its margins are just poor compared to peers like Ferrari and Porsche, albeit more prestigious peers, of course, that are successfully run businesses. But I need to see a lot of margin expansion with this business, which I'm not so much seeing right now. The four key markets where this company does the majority of its sales, or how it breaks them down, are the Americas, United Kingdom, EMEA, so excluding the UK, and APAC. In the Americas, basically flat, 0% growth. Actually, deliveries down, or wholesale deliveries down by 4. In the UK, up by just 1, so again, essentially flat. In the EMEA, excluding the UK, this is the major growth driver for this business. That was up 19%. In China, again, flat. Or in Asia Pacific as a whole, they were actually down 3% in China. But Asia Pacific as a whole, basically flat. So the only real growth market for this business is EMEA, which I just really can't see going on much longer. They really need to have their brand crack into the Americas more, and I think the UK is a pretty much a saturated market for Aston Martin right now because of how long and how prestigious that brand is there, how long it has been in that market. It's its oldest market. I think the addition of an F1 team will definitely help, as F1 is expanding around the globe massively, but this needs to all be a lot quicker for my liking. A slight positive is that from 2021 they have strengthened their liquidity position with now £583 million of cash balance, but comparing this with the debt is still not for particularly pretty viewing. And while the net debt is decreasing, that is pretty much only because of the increase in the cash balance. Gross debt actually increased year over year, which is particularly concerning. This business is still absolutely leaking cash from its free cash flow and needs to right size the ship before this is an investable business, in my opinion. I'm not interested in adjusted profits, so while across the guidance they are forecasting pretty decent increases in their adjusted EBITDA, that doesn't so much interest me. What interests me is the green target at the bottom, targeting to become sustainably free cash flow positive by 2024. Now, for my liking, I think this has been an incredibly poorly run business. However, it was in a very, very poor state when it was took over by the new management, particularly Lawrence Stroll. I think where they are now is a lot better than where they were a year or 2 years ago, certainly. For me, becoming sustainably free cash flow positive by 2024 is a realistic target. It's just not happening fast enough. This business shouldn't be so hard, in my opinion, to make free cash flow positive. I think while they are relatively on track, I just don't think we should trust this business to be consistently profitable by 2024 with its current operating outlook. There are definite tailwinds for this business. I think, as I've mentioned a couple of times, the entry into F1 by the Force India team is a big boom for this business. F1 is absolutely exploding around the world with the growth of Drive to Survive, and it's finding a whole new audience. And like many of them, they can sell merchandise, they can get the Aston Martin name further around. But I also think with a luxury brand like Aston Martin, and that's what it is really a luxury brand, no one actually needs cars that are that expensive. It is difficult that you could water down and dilute the brand's prestige in somewhat if you're selling t-shirts with the Aston Martin brand on it. However, I think overall it'll be a net positive influence. I think it is necessary really to drum up some interest in countries outside of the UK, particularly in the Americas. The fact that the wholesale unit sales are basically the same in the UK and the Americas, where the Americas have 6 times the population, is just not really what I'm looking for in this business. It needs to increase dramatically. Of course, almost any business is a decent investment at the right price in my opinion. However, it's just incredibly difficult to value Aston Martin right now because it's not producing any consistent earnings to speak of, and it hasn't done pretty much its entire time on the public market. Right now, its price to cash flow is around 7.79, but of course, that's operating cash flow, adjusted operating cash flow. The most recent free cash flow numbers were nearly minus 300 million pounds, so it's hard to go with that. So looking at these numbers, I don't really understand how anyone could come up with a coherent valuation for this business unless you're valuing it at price to 2024 adjusted EBITDA. I mean, are we really going to do that? I just don't think that's a business I can invest in at these numbers. Right, based on its forward EBITDA mark that it's predicting, it'll be around 3 times if it stays its current £1.5 billion market cap. It's predicting around 500 million in adjusted EBITDA. So we're looking at 3 times adjusted EBITDA. But again, it's adjusted. How much of that is actually going to be EBITDA, earnings, free cash flow? Probably not a lot. If anything, maybe a loss. So I just don't think it's really possible to come up with sensible valuations for this business. That's really why I'm out of this business. If I can't come up with a valuation at all, never mind a sensible valuation, a fair valuation that I'm willing to pay, then I'm not going to invest in this business. I definitely think there's money to be had here. This is a decent turnaround play. Of course, if you'd bought at that 52-week low, you're very happy right now. I do think there's a chance, albeit a small chance, but definitely a non-zero chance that this business can get back to £10 in the not too distant future. However, I just think the degree of difficulty involved is extremely tough, and I'm not really seeing any demand growth, even with the massive influx of eyes from F1 around the world. So for me, this is a stay away right now. I'm surprised the short interest isn't higher in this business right now, but that's not for me to say. I'm not really the person who shorts companies. However, let me know what you think in the comments down below. Of course, I'm not a financial advisor, so you should do your own research and due diligence, not just buy or sell things because I have to say so, or that's my opinion. I'm not a financial advisor. Do your own research, buy your own stocks. Like and subscribe if you enjoyed the video. I'll see you again next time.